Good afternoon. I will call to order this regular meeting of the Public Safety, Civil Rights, and Emergency Management Committee meeting today. Today is July 23rd, 2014. I'm Councilmember Blong Yang, Chair of this committee. With us today are Councilmember Reich, Vice Chair Councilmember Gordon, Councilmember Warsami, and Council President Barbara Johnson. We have 5 items on our agenda today, and we're going to switch it up a little bit. We're going to take care of the consent items first. We're going to have the mayor's office do a brief presentation for the discussion, and then we will go to the presentation piece. The first 3 items on consent are: 1, to authorize a contract with the MPHA, Minneapolis Public Housing Authority, in an amount up to $108,825 to support a sergeant investigator for 1 year in relation to the MPHA Housing Choice Program. Item 2 is to authorize agreement with the University of Minnesota for Minneapolis Police Department to provide bomb detection services for the 2014 Minnesota Vikings football games at TCF Bank Stadium, with an estimated cost of $28,860 to be reimbursed by the Minnesota Sports Facilities Authority. And the third item is to authorize a contract with ECHO in the amount of $54,750 in support of the If You See Something, Say Something public awareness campaign. Council members, anybody want to pull anything off for discussion? All right, hearing none. All those in favor, please say aye.
Aye.
Oppose? Motion carries. Yes, President Johnson.
Mr. Chair, I have an item, and I'm just asking for your thoughts about where we would put this. I want to request some information from the police department. So should we put that under discussion? Is that
Sure, that would
Okay.
be great.
All right, then we'll make that number 6. All right, and I'll ask the question when it's that time. Thank you.
Okay. All right. Is Diane Halsey here from the mayor's office? Okay. Well, we will go to your question, Council President.
Okay, thank you, Mr. Chair. I think it would be helpful. We have, the mayor's having a press conference, I guess, as we're meeting, to talk about police resources, increased police resources for a couple precincts, 4 and 3 in Minneapolis. And one of the things that I think that we've kind of lost in the transition a little bit as I'm thinking about it is a detail of police staffing levels. And I know we used to get a report, and I can't remember exactly when it didn't come anymore, but we used to get a monthly report about staffing levels in each precinct. And so I would like to request that from the police department once a month, that we get that information. And then also I want a report on response times for the individual precincts. I have concerns from my constituents that there are very, very long wait times for what you would call a priority 3 and 4 calls in North Minneapolis. I appreciate the intensity with which police respond to the really extreme things, but I'm hearing from my constituents that there are very long waits for some of the nuisance calls. And so we used to also get a report about how long people have to wait for by precinct for a response for priority 1, 2, and 3, 4 calls, and I'd like to ask for that information as well.
And Council President, as I'm new to this, is that just us making it clear to the police department that that's what we want, or should we do some sort of motion on that?
It would be a staff direction. I'll make the staff direction, and I'm sure they're listening to this committee meeting, and so we'll probably have it at the next meeting or a meeting after that.
That sounds great.
Thank you.
And I do want to say this, that Council President, thank you for your hard work in terms of pushing the city and also the police department to increase the staffing levels up in 4 and also in 3. I think that's much needed initiative just because of the increase in crime that has happened. I think people have read all across the news that there has been a spike in crime, especially violent crime, up in wards 4 and 5, and this increased police presence is going to be very needed and welcomed. And so, thank you for your help on that, Councilmember Gordon.
I'll just note that there's also been increases and concerns in the 3rd precinct as well, so I really appreciate that the staff direction is actually going to ask for all the precinct-wide response levels and staffing levels, and I think that'll be informative.
Okay. All right, well, we have an item with the mayor's office, but I was told that...
Mr. Chair?
Yes.
I'm sorry to interject, but I believe it would be appropriate to vote on the proposed staff direction.
Okay, sure. Well, I will move that we support or approve the staff directive. All those in favor, please say aye. Aye. Oppose? Motion carries. As I was saying, the mayor's office was going to do an introduction and a report on the continued development of the racial equity framework, equitable solutions for One Minneapolis, but I was informed that the person that was going to give that presentation was going to be a little bit late, so we're going to head right straight to our presentation, and when this is done, then the mayor's office can come in at that time. I'm going to give a little introduction, and then I'm going to pass it over to the vice chair, and he's going to give some background on this as well. But I wanted to thank Professor Orfield from the University of Minnesota Law School. I wanted to thank Wells Fargo for agreeing to come to talk to us about this. Not too long ago, maybe a few months ago, Professor Orfield wrote this report about Twin Cities in crisis, unequal treatment of communities of color in mortgage lending. And, this was an opportunity to hear from him and also hear the response from Wells Fargo. I wanted to make clear that the invitation was out for U.S. Bank as well. And so today we have Wells Fargo and we have Professor Orfield. I'm just going to go over some of the ground rules really quickly. Professor Orfield's going to start first. He's going to give a 30-minute presentation. Wells Fargo is going to follow, and they're going to give a 30-minute presentation. And we're going to hold all the questions until the very end. And once Wells Fargo finishes its presentation, then committee members, you can direct the questions to either parties. And so with that, I'm going to turn it over to Councilmember Gordon to give a bit more background if he chooses.
Well, thank you very much, Mr. Chair. I think you covered the background well. When this report first came out, there's some concerning issues in there, and as most people know, the city of Minneapolis has been dealing with the foreclosure crisis and lending issues for a long time. There was actually a report several years ago that seemed to indicate there was some disparate treatments depending on who was applying for a loan, and really this was an updating that came in April. And I think, to my concern, it seemed like there really wasn't a lot of progress that had been made. I know there was a press conference about this, and there was some press and publicity about it, but it really seemed appropriate that this is the kind of information that it would be helpful for the council to have firsthand. And one of the things I'm always looking for is how we can actually take the research from our wonderful institutions in the Twin Cities, including the University of Minnesota, and see how we can use that to better inform our policies and our decisions in the future. And it seemed appropriate that we have a presentation to the committee, and it also certainly seemed appropriate that we invite others with some expertise, and Wells Fargo in particular, to also respond and help us. My intention is to better understand the problem and then also think about, well, what things could we actually do to make sure if we get another report like this in 5 years, we hear a different story and we get a different picture.
All right. Well, with that being said, Professor Orfield, you're starting this.
So, let's see, PowerPoint. You know how to unlock it? Up a minute ago.
So while this is being worked out, For the speakers, I will give you a 5-minute warning. When you look at my hand and it looks crazy, that's the 5-minute warning. But that's about it, though. I'm going to try to cut you off at 30 minutes. So, try to be as concise as you can in 30 minutes.
Well, thanks very much for the opportunity to talk about our report from July of this year. It's a follow-up on a report that we did a few years previously during the heart of the mortgage crisis. Just to talk a little bit about the Institute. The Institute is an institution of the law school that investigates the ways that laws and policies and practice affect development patterns in U.S. metropolitan areas, with a particular focus on the growing social and economic disparities in these areas. Our background reports, we did a series of memos on segregation and mortgage lending in the early 2000s. Then we did our Communities in Crisis report, which I'll talk a little bit about before I get into the most recent report, and then our mortgage lending report in 2009 to 2012. Residential segregation is a serious problem in the United States, particularly for Black and Latino people. Residential segregation really started to take form itself very strongly in the early part of the 20th century, and it continues unabated. Minneapolis, for a very white metropolitan area, is one of the highest degrees of racial segregation, both in its schools and its neighborhoods. Before the passage of the Fair Housing Act, redlining was a practice that government and bank officials would often draw red lines around neighborhoods to indicate places where financial investments would be appropriate or be withheld, areas that were safe for investment, areas that were unsafe. These are some of the maps of the Twin Cities prior to the time of the passage of civil rights laws, and you can see the neighborhoods that were redlined, the red neighborhoods, and a lot of these neighborhoods we're going to see today with more modern maps that are a little bit bigger, but not in very different places. Again, I'm going to be talking a little bit about the patterns of segregation, and there are many negative factors that are associated with racial segregation. In neighborhoods of racial segregation, home values go down and businesses leave. Tax base accelerates in the same, tax base declines at the same time social needs accelerate. So it imposes really hard conditions on cities. It creates a series of health issues. Crime issues are often associated with the concentration of poverty. And these all reinforce negative attitudes toward people of other races because of segregation and a disparate educational system. A lot of our research at the Institute is about the consequences to kids of the growing pattern of racial segregation in schools and neighborhoods, and very, very negative outcomes, particularly in graduation and going on to college. Here's a map that shows the percentage of minority kids in elementary schools, and the red schools are more than 72% non-white. And orange are between 50 and 72, and it goes down to the very blue schools. And you'll see that in many parts of the city of Minneapolis, the schools are very segregated, more than 90% non-white and poor. When we compare ourselves to Portland, Oregon, or Seattle, Washington, areas that have very similar racial demographics with Black and Latino people, we have 90 schools in the metro area, 90 elementary schools that are more than 90% non-white and poor. Portland, Oregon has 2. And Seattle, which is a third bigger, has 26. Our neighborhoods are equally much more segregated than Seattle and Portland, places that are very similar. And these conditions of racial segregation have very serious outcomes on kids and neighborhoods, and they're also associated with some of the patterns we're going to talk about in terms of lending today. Poverty is related to racial segregation. I'm going to skip ahead because of my limited time about outcomes in schools. We also find that in parts of the country where the neighborhoods and schools are more integrated, we see lots of better things happening. We see kids doing better, kids moving through school into higher education better. We see less health disparities. We see less disparities in crime rates. We see a lot more economic mobility. In racially integrated areas like Portland and Seattle, we also see much better lending patterns. So segregation, just to finish this before I get into the mortgage data, and I'm going to try to move along, segregation is not just a matter of choice. Choice has very little to do with it. It's not simply a result of housing markets neutrally sorting according to socioeconomic status. Poor white families have a tendency to live in middle-class neighborhoods. Poor white kids are going to majority middle-class schools. Poor black and Latino kids in this metropolitan area, 3/4 of poor black and Latino kids are going to schools that are more than 75% poor. 3/4 of poor white children in this metropolitan area are going to schools that are more than 70% middle class. So there are very different patterns. It's not just about poverty. There's also a number of racially discriminatory practices, and I'm going to talk about the public actors and also the private actors. We have on the public side, we have housing policies of the government that concentrate affordable housing in very poor neighborhoods and not in whiter neighborhoods. We have the decisions of school districts, which tend to separate kids on the basis of race. We've seen a number of decisions like that in Minneapolis, with the schools in southwest Minneapolis becoming whiter, much whiter, and the schools in the rest of the city becoming very non-white. The land use policies of municipalities in terms of the way they zone for all these things. These are important components. Private actors, steering by real estate agents. We've been working with a lot of racially diverse school districts in our institute, Hopkins, Osseo, Richfield. Many of these school districts report that white families are not shown housing in certain areas where the schools are becoming diverse. White families and black families of the same income are told different things about neighborhoods. We had reports from about 5 of the diverse school districts that this was a very fundamental problem in terms of their ability to keep schools integrated. Finally, what the topic we're going to talk about today is discrimination in the mortgage process and the financing of homes, or the appearance of that. Private lenders continue to deny mortgages to minority home buyers at disproportionate rates. The growth in loans during the 2000s was due in part to the emergence of a dual mortgage market in which segregated minority homeowners into subprime markets. Subprime loans have higher interest rates and less favorable terms for the applicants due to the supposed risk in borrowing them. Subprime home mortgage purchase loans often consist of adjustable rate mortgages, balloon payments, with the promise that property values and home equity will continue to climb, and an applicant can later refinance into lower interest loans. It gives you a sense of the housing market boom and the prices. This is the Case-Shiller Index, and you see the steady increase in the price of homes up until 2006, and then the rapid decline after the beginnings of the mortgage crisis. Predatory practices resulted from a lack of regulation in subprime markets, and they are much more common in neighborhoods of color, and neighborhoods of color were hit much harder. Neighborhoods that are racially diverse were hit much harder than white neighborhoods. The white neighborhoods of Minneapolis were largely unaffected by this crisis. The white parts of the suburbs were largely unaffected by this crisis, but you're going to see the racially diverse parts of the suburbs, at least early on, were affected very strongly. The Home Mortgage Disclosure Act is the basis of this study. It provides public loan data that can be used to assist in determining whether financial institutions are serving the housing needs of their communities. Public officials, when they're distributing public sector investments, look at this data and try to attract private investment to areas where it's needed. And it's a tool that is useful in identifying possibly discriminatory lending patterns. And so that's what the Home Mortgage Disclosure Act. Here's where percentage of the home loans that were subprime in the Twin Cities by race and ethnicity between 2004 and 2006. And you'll see that for American Indians, it was 36%, Asians 20%, for black purchasers 48%, Hispanic 36%, Asian Pacific Islanders 23%, whites 14%. So for whites, about a third of what it was for black families. This is subprime loans and purchases by income and race between 2004 and 2006. And the top line is black homeowners, black purchasers. The bottom is white, the blue is white. The yellow line is Asian, and the green line is Hispanic. And you'll see that black families are much more likely to be purchasing homes with subprime loans during this period. At the lowest end of the income spectrum, at $39,000, there was a 4-to-1 ratio. So blacks were 4 times as likely to be using subprime loans. And even at the high end, there was a very huge ratio, 6-to-1 ratio between black and whites at incomes above $157,000 a year at that time. Percentage of home refinance loans that were subprime. And you'll see, again, black families at the top of the scale with more than 40% at the lowest end, below $39,000. As you move up to black families that are earning $157,000, it really doesn't change that much. It goes a little bit below, but it still stays pretty much the same. So whatever your income, that incidence doesn't change very much. White families at very low incomes, much less likely to be using subprime loans, and at very high incomes, there's a 4-to-1 ratio, just like we talked before. This was subprime lending by neighborhood, and I know that you in the city are very familiar with these patterns. We looked at the schools a little bit, but you can see the percentage of population in the first slide are people of color by census tract in 2000. You can see in the second slide the percentage of home mortgage loans that are subprime by census tract between 2004 and 2006. And they really look like the same map. I mean, it's really hard to see much difference, whether you be in the cities or the suburbs. The non-white neighborhoods are the subprime neighborhoods. The white neighborhoods really, at least during that period, not very much subprime activity. If you take a look, this was a table that we took from the National Community Reinvestment Coalition. It showed the number of bank branches in neighborhoods, in high minority neighborhoods. And this particular statistics from this source showed that Minneapolis had the smallest number of bank branches in high minority neighborhoods of the 25 largest regions. Here's subprime lending. This is the percentage of home loans required by people of color by census tract between 2004 and 2006. And again, you can see a very high percentage in the non-white neighborhoods of the city. The percentage of loan, this is where Black and Latino families were getting these loans in the non-white neighborhoods. You can see the percentage of subprime loans by census tract, so you can see the two are quite similar. The percentage of foreclosures, and again, the concentration of subprime lending in certain neighborhoods was powerfully associated with foreclosure crisis, and it had when subprime loans were concentrated in neighborhoods of great poverty and disadvantage, it had really devastating multiplier effects on those neighborhoods in terms of the impression of those neighborhoods, the broad-scale abandonment of those neighborhoods, the difficulty of those neighborhoods to resettle themselves. The predatory lending was not only predatory toward the individuals who lost, a lot of times, Black families who lost the wealth that they had accumulated, and a huge percentage of these subprime loans were refinance loans. A very large share of them were refinance loans for homes that had been purchased before. Not only a tremendous loss of their wealth, but also really a devastation of those neighborhoods, leading to levels of abandonment and disinvestment in neighborhoods we've really never seen in this metropolitan area. Places like Detroit and Cleveland and Milwaukee have neighborhoods like this pretty commonly. We have not up until recently. This is the relationship between subprime lending and foreclosures, and it shows that as you have a very high percentage of subprime loans in the neighborhood, it's very strongly correlated to foreclosure activity. And so foreclosures are not just about the individual loan that the person's holding, but also there are multiplier effects based on the characteristics of the neighborhood. Here's recent trends. Now you can see this is subprime lending for home purchases and refinances in the Twin Cities. And the first line is the blue, the subprime loans between 2004 and 2006. The red is between 2009 and 2012. So you can see that subprime lending really slowed down after that period. You can see for American Indians it went from 36 to 4, from Asians to 20.8 to 0.7, from Blacks from 48.2 to 1.8. So the really dramatic change in the incidence of subprime lending. Subprime lending really slowed down, period. Here are the percentage of home purchase applications that were denied or not originated by lending institutions in the Twin Cities. So you see for American Indians about 50% are either denied or non-originated. Asians, you've got in the mid-20s, Black families in the low 30s when you combine the two, and Hispanic families, Pacific Islanders, whites. You can see again whites have the best circumstances among all the diverse groups of people. This is the percentage of refinance applications that were denied or not originated by lending institutions. And again, you can see pretty stark racial disparities with Black and American Indians and Latinos having a pretty hard experience, and whites much more likely to have their loans originated or approved. When we look at the most recent data in terms of the percentage of home purchase loans denied by race and income, we see Black families at a much higher rate at every level of income. So you see at very low incomes that Black families, or I guess in this case, Hispanic families have the largest disparity at high income. So almost a 2-to-1 ratio of denial at the lowest levels of income. And as you move up to the highest level of income, you will see that a black family that earns $167,000 a year is about 3 to 4 times as likely to be denied a loan than a white family of the same income. In the previous statistics, we'd often seen black families at above $157,000 a year were less likely to qualify for a prime loan than white families at $40,000 a year, based on the HMDA data. And part of this gets you into the nature of the data, and is the data good enough? And I know there's been some letters back and forth saying, talking about methodological imperfections of our study. And one says that we don't have access to the credit histories of people. That's clearly true. The HMDA data doesn't provide that. But we have tried to find other studies. And in our first report, the 2009 study, we tried to survey the field and try to find those instances when people had this data and had also access to the credit history data. And there were a limited number of academic studies, about 4, and there were a number of cases in response to litigation where this credit access data became available. And there was very little difference between these data, the HMDA data, and in the small instances when the credit data had become available. And we're looking, again, we're looking for other studies, for other information to try to do that. But I mean, the best way to figure out whether this credit history data is really going to change the scale is to try to find and make it available one way. A lot of times the only way that it becomes available is through litigation. And that's unfortunate. But in other cases when scholars have had access to that data, which we clearly do not in this study, the disparities are not very different. Another point that was made in response to our data is that we didn't include VHA and FHA loans in our study. And we didn't, partly to make it comparable to our first study. But then we did follow up, and we did include the VHA and FHA loans. We put them into our study. And again, I wrote a letter to the city on April 28th, 2014, and again, adding those 2 types of loans, we didn't see that they made much difference in terms of these disparities. So with that, I mean, obviously we don't have all of this data, but in those limited cases, then when other people have had access to it, hasn't changed it very much, and it would be interesting to hear from others that testify whether there are other instances, where there are published studies when this credit history data is fully available to the public, whether these statistics change very much. Because we haven't been finding that doesn't mean it doesn't exist. This is the percentage of refinance applications denied by race, and you can see very low income families, black families, about a 1.7 to 1 ratio, and it doesn't really change in terms of these disparities over time. Now, the one thing about home purchases, it feels like black families, no matter what their income, they don't seem much more likely to get prime credit. It stays about the same. In refinance loans, it looks like it gets a little bit better with income. Neighborhoods, again, the same neighborhoods, the percentage of population that are people of color by census tracts in 2010, and the neighborhoods in 2010 are more segregated and more troubled, more disinvested, have less social capital than they did 10 years ago. They're much weaker neighborhoods in almost every measure that you can measure. But again, you see very similar patterns with those neighborhoods not being very well served by prime credit. Much weaker neighborhoods than they were before the subprime mortgage crisis. We took a survey to try to figure out what would happen if loans were distributed across the region according to the income levels of the area. So we looked at the census data and the income levels of the residents and the homeowners. And what if the homeowners with the same incomes were as likely to receive loans regardless of where they lived? What would look different in terms of these measures? And we found that an additional 13,300 loans would have been made to diverse and predominantly non-white neighborhoods in the Twin Cities. The bulk of additional loans would have been refinance loans, about 11,972, which would have allowed many more homeowners to renegotiate more costly subprime loans into prime mortgages. Could have had a very good effect on that change. And we listed the neighborhoods, and as you know, the neighborhoods of the north and the near south were the ones that would have seen, if loans were based on incomes, would have done a lot better. So the summary recommendations. The subprime period of lending complicated the way discrimination occurs by offering greater volumes of loans with higher interest rates under less favorable terms to borrowers. The lack of oversight over the housing markets led to the financial crisis of 2008, ushering in today's disparate patterns of lending that has more in common with past lending practices. We don't see the subprime loans anymore, but we don't see really much change in the way these neighborhoods are experiencing prime credit. In the Twin Cities, people of color were more likely to get a subprime loan and be denied a prime loan than whites with similar incomes. A high-income black applicant was much more likely to receive a subprime loan and be denied a prime loan than a low-income white applicant. So a black family that was earning $157,000 a year was systematically less likely to get a prime loan than a white family that was earning $40,000. Now, perhaps that's all you can say. The credit histories will explain that. And it would be good to take a look at those credit histories. Credit histories are not accessible to scholars in the way that we can make those determinations. Credit histories are proprietary information, and even the algorithms by which credit scores are determined are proprietary. So even the methods that banks use to determine those credit scores and their consultants are not public. So we can't reproduce these because we don't know what the algorithms are. But we don't have the data, and all we know is that when the studies with the data have been available, it really hasn't changed it very much. It's been a little bit better, but it hasn't changed it very much. The facilitation of subprime loans into communities increased foreclosures, which in turn helped to create the woes that are now used that help justify low lending rates into those same communities. So it's absolutely clear that these neighborhoods are in worse condition than they've ever been in. They are less strong than they've ever been. But part of that is based on the predatory lending that occurred there. Wells Fargo, Bank of America, HSBC, holding companies are all examples of major financial institutions that have held subprime lending subsidiaries. Lenders could do more to open up current prime-oriented markets for communities of color. The Wells Fargo loan could have made an additional 4,247 loans to diverse and predominantly non-white neighborhoods if distributed loans according to the income mix of the neighborhoods. Recommendations, we should be strong about enforcing the current fair housing and lending laws. We should be urging state and federal authorities to do that. There has been very little enforcement of these laws. We need more traditional banks and lending in disinvested and in racially diverse neighborhoods. Our study points out it's not only the non-white neighborhoods that are hurt, but it's the racially integrated neighborhoods and the racially integrated suburbs that are being hurt. We need to bring back a fair housing center in the Twin Cities. There once was a fair housing center that helped monitor this. More transparency of banks' information about lending decisions, et cetera, which sure we'll talk about. So we have an incomplete study. We don't have all the data on credit histories, but we have all the data that is available to us. I'd be happy to look at the credit history data if it was made available. We'd be happy to analyze it, or it would be good if some independent agency could do that. In the few instances when we have found, we've searched for published reports, published peer-reviewed reports about when this credit history data had become available, and it didn't change the equations very much. Now, it could be that we are missing things. It would be important, I think, to find that out and do due diligence on all these issues. But we have some very serious problems. We have some very serious racial segregation that's occurring in the metropolitan area. It's getting worse. The government is complicit in this, and so is the private market, and it doesn't help anybody. The lending is a part of the problem. The neighborhood conditions are bad, and banks say that they can't loan in them because the neighborhood conditions are bad. The neighborhood conditions get worse, and it's a spiral. And so it's hard to say that one single force is responsible for it, but the overall condition is very detrimental. In parts of the country that are less segregated, these problems are much less severe. So I hope I haven't taken too much of my time. You have a professor who used to be a politician, and sometimes it's hard to keep him to 30 minutes. So I guess I'm supposed to sit down, yeah.
You're way under, but thank you so much for being done way early. All right.
Might I ask just an informational question
Sure.
of Professor Orfield? And it's just the term, what is a non-originated? It's you said, and I can't remember, that there were two terms, and one was loan application, and then non-originated.
Yeah,
What's the
the
difference?
denied is where you have a clear record that the application was denied, and on the other part of it, the non-originated, just didn't go forward. It didn't produce a loan for
So
whatever
an
reason.
application was made, but it didn't.
That didn't-
Okay.
yep.
Okay.
All right, the representatives from Wells Fargo, please come up and introduce yourselves, and then go ahead.
Chairman Yang, Vice Chairman Gordon, and members of the committee, my name is Dave Kwame. I'm the CEO of Wells Fargo, Minnesota. And Brad Blackburn's also with us. He's my colleague from Wells Fargo Home Mortgage. And I'll make some remarks initially, and then Brad will follow up my remarks. I'm happy to have the opportunity to give you the facts about Wells Fargo's record of commitment to Minneapolis and our home mortgage lending leadership in the city and in the entire region. Brad Blackwell will expand on our commitment to responsible and fair lending and our results in Minneapolis. And he's going to share with you why we believe that the Institute of Metropolitan Opportunity misrepresents our lending performance. I first want to emphasize that we fundamentally agree with Professor Orfield that the home ownership gap between white and ethnic minority residents is an issue that needs to be addressed. However, the home ownership gap is a reflection of a broader economic gap and is substantially more complex than the IMO report would have you believe. In that spirit, we welcome this opportunity to provide you with the facts about our lending activities in Minneapolis and ask you to consider all the information about our efforts to serve the entire community, not just the incomplete and incorrect picture painted by the IMO report. I also believe that it's important to understand that Wells Fargo's vision is to satisfy all our customers' financial needs and to help our customers succeed financially. To successfully realize that vision, we must seek out and serve every customer in the community and provide them with multiple products, deposit accounts, credit cards, investments, mortgage loans, and more. Without jumping ahead to my colleagues' remarks, this might be the single most flawed notion of the IMO study, that we would somehow shy away from making loans to qualified borrowers. This assumption is simply not in keeping with our company vision or aligned with our business objectives. For decades, Wells Fargo and the city of Minneapolis have worked together to address issues of mutual concern, such as housing, transportation, jobs, and more. Our company is a leading employer, lender, taxpayer, and charitable donor in the city and throughout the region. We value our relationships in the community, and we're committed to continuing to work together to make Minneapolis a great place to live, work, and to do business. We're the city's largest mortgage and small business lender. We have more bank locations in Minneapolis than any other lender in the city. We're the #1 lender in low and moderate income neighborhoods and to minorities in the city of Minneapolis, in the state of Minnesota, and in the nation. Today, we have nearly 24,000 mortgage customers in the city of Minneapolis. 98% of those customers are current on their loan or have only missed one payment. Since 2009, for every one customer that has gone through a foreclosure sale, we have helped or we're in the process of helping one other customer through a modification or another workout option. Our company and our predecessors have had a strong presence in this city since the 1920s. 2,700 of our team members are proud to call the city home. We also have nearly 11,000 team members working in the city of Minneapolis, and we have 17 bank stores in the city. And we invited some of our store managers and some of our mortgage consultants to this committee meeting so that they could hear firsthand about this important issue and they could understand how important the great work that they're doing in the community is. If you'd like to stand, please, the Wells Fargo team members. Thank you for being here. In 2013, Wells Fargo team members who work in the city volunteered 119,000 hours to help nearly 2,800 organizations in the region. And we're working hard in our retail bank and our other businesses to ensure that the diversity of our team members matches the diversity of our community. In fact, in our retail bank stores in Minneapolis, 2/3 of all of our team members come from racially or ethnically diverse backgrounds, including more than half of our team members in management roles. That's the direct result of a concerted effort that we've had to recruit and retain team members who reflect the communities that we serve. Wells Fargo also is proud to anchor the Downtown East project, poised to transform our downtown. Upon completion, we're going to own more than 1 million square feet in 2 office towers that's the equivalent of the IDS building, that will become a permanent home to approximately 5,000 Wells Fargo team members. Our $300 million investment in the Ryan project is without any tax increment subsidy, and it's one of the largest commercial real estate projects that our company's ever undertaken. It's also important to remember that Wells Fargo has invested more than $200 million in its home lending campus in South Minneapolis' Phillips neighborhood since we acquired the former Honeywell complex in 1999. That investment paved the way for other corporate development in the area and has played a major role in the revitalization of that neighborhood. We agree that lenders, city officials, community groups, and others always can do more to help promote home ownership in all of the communities we serve, and we've always been willing to engage in an effort to advance that goal. As that brief overview of the facts about Wells Fargo's commitment to Minneapolis and our track record as a leading mortgage lender in the city clearly demonstrates, we're working hard to support this community and to be part of the solution. And at this time, I'm going to turn it over to Brad Blackwell from our Home Mortgage Lending Group to provide you with more details about our approach to fair and responsible mortgage lending and our results in the Minneapolis area. Thank you. Brad?
Thanks, Dave. Chairman Yang, committee, thank you very much for allowing us to come talk to you today. First, I'll reiterate what Dave said, that Professor Orfield's work is based in a true and important effort to determine what are the causes of the racial disparities that are taking place in Minneapolis, and as he said, less so in some other cities around the country. But also it's an issue nationally that we need to deal with. It's an important issue. It's a complex issue. It is certainly one that can't be boiled down to the lenders don't want to lend or something along those lines. So I want to talk to you a little bit about the fact that, we're also concerned about this homeownership gap. I want to talk to you about what we've done over the course of the last decade, what we're currently doing, and where maybe we can take this in the future. I also want to talk a little bit about some of the what we see as flaws in the research, or more probably missing information in the research that leads it to come to a bad conclusion. I can tell you that we at Wells Fargo hated to see this report. I know it wasn't a condemnation of Wells specifically, it was more an industry-related one, but when we appear in the report as the largest lender in Minneapolis, it's something that we and the rest of our team members take very personally. We thank you for inviting us here, and we want you to know we showed up. We want to talk to you about this issue. It's an important one. Dave talked about our vision and values, that we want to satisfy all our customers' financial needs and help them succeed financially. We actually have a booklet that lists our vision and values. Diversity is a very important part of it. It was written by Dick Kovacevic, our former CEO and chairman, a few blocks from here. He wrote it in a desk. It was a desk where he didn't have a seat. He stood up. He wrote this thing and over 20 years ago, and it has been driven deeply into our culture. It's something every one of our team members can tell you, and we search for ways to satisfy that vision. To say that we don't want to make a loan to someone that's qualified is like saying that Mrs. Fields doesn't want to sell cookies to someone coming into the store that's hungry. Mortgages, loans of all types are our product. That is what we offer. I would love to say that we could do 4,000, as the study showed, 4,000 more loans in the city of Minneapolis alone. We would love to do something like that. I want to talk to you about why that study is flawed and what perhaps, to give you some illumination into what the issues are, and then we can work together to find solutions. So first, let's look at the past. Over the course of the last decade, Wells Fargo both continued our practice of responsible lending and adopted very strong responsible lending practices. We did not do those negatively amortizing option arms that became so popular in 2003, 4, and 5. They were done successfully by the thrift industry for the previous 20 years, but when we got into the 2000s, other lenders picked them up, were securitizing them, selling them irresponsibly. We chose not to originate those loans. There was also in 2004 another product emerged that was very, very popular with lenders called a stated income subprime loan. You're probably familiar with that. You have poor credit, and you tell us what your income is, and we trust you, and we make the loan. Wells Fargo took one look at that product in 2004 and made a choice not to make those loans. Now, I can tell you those two decisions alone, along with all the, I mean, we made a lot of other decisions for responsible lending, but those two decisions alone, not doing negatively amortizing loans that were so popular and not doing stated income subprime loans that were so popular, cost us significant market share in 2005, 6, and 7. And I, at the time, was heading Wells Fargo's national sales organization for mortgages. And I got to tell you, the pressure on us, so why aren't you growing your market share, was very strong. But we held firm. We said we are not going to do those loans. As a result, our delinquency and foreclosure rates are significantly below industry averages, significantly below industry averages. And most of the lenders that were doing that type of business are no longer in business any longer. You probably can think of the names of many of those companies. They do not exist anymore. I will say we were ultimately paid back. Once the crisis hit, Wells Fargo's market share went up substantially because we'd been, deeply penetrating the markets of high quality lending over that time, and so we did gain market share over that period. From 2009 and 2012, Wells Fargo's originated nearly 11,000 loans in Minneapolis itself. It's over a quarter of the market, over 25% share of the Minneapolis market. We were the #1 originator overall during that time. We were the #1 lender to all racial and ethnic groups during that period of time. In fact, in Minneapolis, we originated more than twice as many loans overall as the #2 lender, and over 3 times as many loans to minority home buyers and borrowers as the next closest lender. And if you look at our market shares among various ethnic groups, we had 2012, let's just look at 2012 alone. 2012, we had a 24% share of the Minneapolis mortgage market. Our African American market share was 24%. Our share of the Asian mortgage market was 24%. Our share among Hispanic borrowers was slightly lower at 22%, but still in the same ballpark. If we were actively looking to not lend to minority groups, you would see a markedly reduced share of the loans that we did to minorities than what we did to white borrowers. Also in census tracts where the population was predominantly non-white, our market share in 2012 was 23% compared to 24%. So this idea of redlining is completely false. The last thing we would ever do is make a decision on a mortgage by race or ethnicity. It's the furthest thing from our mind. In fact, exactly the opposite, and I want to tell you why. About a quarter of the Wells Fargo home mortgage consultants in Minneapolis that are helping home buyers in Minneapolis come from diverse backgrounds and have the ability to serve customers in 9 spoken languages. I want to read them to you. English, of course, Spanish, Hmong, Somali, multiple Chinese dialects, Bosnian, Hindi, Serbian, and Vietnamese, and we actually have team members that can do American Sign Language. These aren't the types of actions that a lender would take on to seek out, hire, and support team members reaching multiple languages into multiple communities that is trying to avoid making loans in minority neighborhoods or to minority borrowers. In fact, to the contrary, because we know there's a home ownership gap, we're doing everything we can to reach those home buyers and find ways to make them loans. One of the ways that we did that was that our HMCs, many of them that are here, conducted dozens of first-time homebuyer seminars, affordable housing workshops for a wide range of groups and neighborhoods throughout the city. One example, we hosted a free home stretch event that provided more than 90 families with homebuyer education certification in English, Spanish, and Hmong. We also have worked with the NAACP and the Minneapolis Urban League to host homebuyer forums for more than 170 households. And then many of you may be familiar, I hope you are, with a program that we launched in Minneapolis and St. Paul in September of 2012 called Neighborhood Lift. Neighborhood Lift was a program where we took a look. I'll give you a little background. We took a look at what was going on in the home buying market in the country, across the country, and we said it's not going fast enough. This has been a painfully slow recovery since we hit bottom in 2008. And Wells Fargo, as America's largest home lender, said, what can we do to get more home ownership taking place, more home buying taking place? And we said, well, we're just one company, but why don't we devote some of our money to grants for home buyers to buy homes? And in Minneapolis alone, we delivered more than $4.2 million in down payment assistance grants to 282 qualified home buyers, the majority of which were in low-income census tracts. Those homes were purchased in low-income census tracts, which, by the way, really helps. You put owner-occupants in those homes, in a time when a lot of homes are being purchased by investors. It provides a tremendous amount of increased stability. Again, these are not the kind of actions that a company looking to avoid lending to minorities would take. We also gave $1.4 million in grants to support efforts focused on directly helping people improve their credit picture, reduce debt, increasing savings, and gain more knowledge about sustainable homeownership. And this is really important. I'm going to talk to you in a minute about what goes into a home lending decision and the types of things that maybe can give us ideas as to what we can do in the future together. But it's not just income. If it were just income, one, things would be a lot simpler, but two, bad lending decisions would get made. So I'll talk to you more about that. But those grants were designed to help all of the factors that are barriers to home ownership today. $200,000 went to the Minnesota Home Ownership Center to study the gap in home ownership rates between white homeowners and culturally diverse homeowners. We're doing what we can to help support the effort to find out all the reasons so that we can, it's important to find out the causal factors so that we can solve them. $390,000 went to Twin Cities Public Television for listening sessions to help understand why some communities don't use traditional banking services and to produce videos for diverse populations about home ownership. And the remaining LIFT program grants went to Build Wealth, Hmong American Partnership, Minneapolis Urban League, Emerge, Clues, Northeast Development Association, Employment Action Center, all to fund initiatives on financial and homebuyer education, counseling, and workforce development. So I've touched on some of the highlights of what we've done, and I truly believe this is a strong record. Not that we can't do more, we want to do more, we're willing to do more, but I wanted to point out that there are many things that we are doing today to try to help the situation that we're here to discuss. So let's talk about the study. Professor Orfield brought up the fact that these neighborhoods are very hard hit. There's issues with the schools. There's issues with unemployment. There's issue with income. There's issues with home values. I can tell you those are not driven by the lending community's unwillingness to lend in those neighborhoods. Perhaps those are some of the causes or something in the, this social issue that we're dealing with are causing some of the lending issues that are taking place, or one of the reasons, but certainly the fact that lenders don't want to lend there are not making all of those issues occur. The divide goes a whole lot deeper than housing and mortgage lending. And unfortunately, well-intended but misleading studies like this one, have us chasing things down a rabbit hole to find a solution that may not exist there. So let's talk about it. First, as Professor Orfield mentioned, the IMO study does exclude government lending. That's VA, Veterans Administration for Veterans, and FHA, or Federal Housing Administration, which are designed as, it's public policy by the federal government to provide low down payment loans that allows for lower credit scores for borrowers to enable home ownership. And by excluding those, just to give you an indication, 23% of the mortgages done in Minneapolis were FHA or VA loans. 43% of the loans done in predominantly minority neighborhoods were FHA VA loans. So I know Professor Orfield said that he corrected for that, but it was pretty quick response from the time we raised the issue to the time we got the numbers back. If this is a deep study, I'm guessing that there's probably more work that needs to be done there. It's also difficult to represent a reasonable perspective on minority lending or lending at all if all you look at is income. So let me just walk you through how a lender thinks about the decision to make a loan. And you would think about it the same way if you were lending your own money. So first is a borrower's ability to repay. So with the borrower's ability to repay, you give them the funds to borrow to buy a home, do they have the capability to repay that loan? Income is one of the factors for ability to repay. However, it's not the only factor in ability to repay. So are the borrower's other debts. If they have a car loan, if they have credit card debt, if they have other obligations, that is taken into account. This study took income, by the way, broadly, not on individual borrowers, but broad income into account, but didn't take into account all of the other debts. And we look at loans on an individual basis, one-on-one, not by groups or classes or neighborhoods, to make a decision. And if someone has too much debt, they don't have an ability to repay. It also takes into account stability of income. So a borrower may have income that fluctuates wildly from either 1 month to the next or 1 year to the next. And so stability of income is a strong determinant on ability to repay. So that's one factor, ability to repay. Second is their credit history. That's sometimes called willingness to repay, but you think about it as a borrower's credit history. Have they paid debts back in the past? You know, if they borrowed, have they paid them back? Have they paid them back on time? If a borrower doesn't pay debts back on time, then they get, they have a lower credit rating. And if they pay them back and borrow and pay them back again, they have a higher credit rating. That is a very important factor as well. Not the sole secondary factor, as Professor Orfield was talking about, but a very important one. So ability to repay, willingness to repay, or credit history. The next is down payment or loan to value on the property. So the thing that the lender will look at is how much down payment is coming in. Down payment is a big factor for lower income homeowners. And by the way, the higher the loan to value being if you put 5% down, your loan to value is 95%, 95% of the value of the property. If you put 5% down on a property and get a 95% loan, that's a riskier loan for a lender than if a borrower puts 20% down. And so consequently, there are higher decline rates for borrowers and higher standards for credit and income for borrowers with less down payment. That was not taken into account into this study. And I'll tell you that if a household has limited means for down payment, either through their own family or through their own personal ability to save, this makes it harder to get a mortgage. And then the final factor is the collateral itself. And as we've already talked about, home values are lower, they're more impacted. A refinance is harder to get if you try to refinance your debt and the property value's gone down. Unfortunately, homes and neighborhoods have been disparately impacted, and that will impact qualification rates. So this is a fairly complex question of why do people get declined, because it could be ability to repay, it could be too much debt, could be willingness to repay, it could be with credit scores, it could be down payment availability, and it could be the quality of the property. Any one of those factors, or usually multiples of those factors, are issues that lead to approval or declination of a loan. It's not as simple as income. So let's now go to what can we do about that? Congress passed in 2010 the Dodd-Frank Act, and the Dodd-Frank Act designated that the Consumer Financial Protection Bureau, or CFPB, develop a set of criteria that will get reported for lenders that is more robust, because Congress also recognized that you can't take the Home Mortgage Disclosure Act, or HMDA data, and determine whether discrimination is going on. The federal government's known this forever. And when we get, believe me, we get examined very carefully by several arms of the U.S. government about our lending and whether fair lending is taking place. And they don't use HMDA data. They come in and look at our actual data as well as the actual data of every other company in America. It's not released publicly, however. Congress has made an attempt to change that with the Dodd-Frank Act. The CFPB at some point in the near future will be releasing what criteria get released. Our hope is that it's enough information to give us a better indication of what might be driving this. Thank you. I guess I'll wrap up just by saying Wells Fargo is, we're the largest lender here in Minneapolis. Minneapolis is our home. I know Wells Fargo's official headquarters today is in San Francisco, but remember, Norwest bought Wells Fargo in 1998, and we're based here. We feel like this is our home. It's an important city to us. It's important the residents are to us. We've always said and will always say that the success of Wells Fargo is directly related to the success of our customers and the success of our communities. We're willing to do whatever it takes to make this successful. And keep in mind one other thing, that in many of the states that we operate, we are in communities that are either majority-minority populations or that are near that case: California, Arizona, New Mexico, Texas, Florida. If we were seeking to avoid, and by the way, the U.S. will be that within the next couple of decades overall, if we're seeking to avoid lending as an industry to minority home buyers, we're seeking to end our existence in the next 10 or 15 years. That is the last thing on our mind. We want to work with you to find solutions. We're doing more homebuyer seminars and trying to find ways to educate, because financial literacy and homebuyer education are really important foundational pieces to increase home ownership. We'd love to work with the city to both publicize those and drive more consumers to them so that we can help to work to solve this problem. So with that, I'll wrap up. Again, thank you very much for giving us an opportunity to talk to you, and we'll be happy to answer whatever questions you have. Thanks.
Thank you. I just wanted to commend the speakers for staying well below the time allotted, and that's wonderful. Councilmember Gordon.
Thank you, Mr. Chair, and that means I guess we have extra time for discussion and questions. It's all very interesting. I did want to say right off that I really appreciate Wells Fargo being here. I think our intention here is not to say you haven't been a good partner or you aren't a good partner with the city. You have been. I think you've been to the table many times in many different ways with us to look at the foreclosure crisis and what we could do and help. And the LIFT program, I think, has just been fantastic. So that's really not the idea. And I don't even think we're even thinking that there's anything intentional going on. So this is really the trick, is to, because it looks like there are vestiges of historical practices that are still lingering, and we're kind of stuck as a community. You've talked about the home ownership gap, and I think that you recognize that. And how do we get around that? And what are we going to do to remedy it? And I don't have the answer to that. I think most of it is probably unintentional, and some of it might actually be played out in some of the practices. I mean, you listed a number of lending factors that go into making a decision. It would be interesting to see, is one of these lending factors really making a big difference? So if it's not credit score, maybe it's debt load, maybe it's a very interesting one you talked about was quality of the property. And so maybe that amounts to what's the resale value on that block or in that neighborhood, and that's too risky. And so that could inadvertently end up impacting Camden or some other neighborhood because that's being weighted a certain way. If we could actually figure that out and we could say, oops, by paying too much attention to that, we have inadvertently made it a lot harder for certain people to get the loans. Let's see if we can't correct for that somehow. It would be interesting if Wells Fargo or some other cooperating lender, but I don't think we'll get one as cooperative as you. You're the only one who's here today, and I think that's really significant, and it's not just a couple of you either. So, but I'm wondering if you collect that data based on ethnicity about the loans and what made the decision to deny the loan, and if you could actually drill down and look at that, and you could somehow come up with, 80% of the Latino loans were denied because of B plus C or whatever it is. So that would be helpful. So I could just ask, do you keep that kind of data yourselves?
Mr. Chairman and council member, thank you. We do have that information. I'm not sure we've calculated it in quite the way that you're talking, but we look at those factors all the time. Be careful. I want to be careful about representing quality of property. It's more value of property. So let's say you want to do a refinance and you've got a $120,000 loan. Your house would need to be worth 80%, or to do a FHA loan, maybe 97%. That would represent. So if your house was worth less than $120,000, it would be hard to get a loan in that case. So I want to be careful about quality versus value. So if I said quality, I misspoke. The factors vary. I'm not so sure you could point to one or two factors. Income is one. Other debts are another big one.
I understand that, and but we won't ever know which is having the impact. We've already controlled for at least one, which is income.
Right.
At least somebody has controlled for income, and it appears as if that doesn't really make the difference.
It is a causal factor, but not to the same degree. And so I think you're right, and I think that the revised HMDA data that the CFPB is putting together will help us draw and help people like Professor Orfield draw some of those conclusions to see if we can identify where are some of the areas that will help point to what either public policy or private policy issues could change to affect the outcome. I think you will find that it's going to be a combination of many of those things, and really the biggest ways that we can help with this issue is, one, through improved financial education. I would strongly recommend that we teach our kids in school a financial education to have them become financially literate by the time they get out of school. I don't know about you. I had a savings account when I was a kid, and I don't think we do that type. And we march down to the bank and we make a deposit. I don't think we do that type of thing anymore. But financial education is critical, and it's not part of our schools today. Second is unemployment and income. Jobs are a key driver, and stability of income is a key driver of a person's ability to both save for down payment and to have that ability to repay over time. And we're, with our economy growing very slowly, that is a significant issue. And then the issue of credit scores and quality of a borrower's credit report is a really important one, and one that we need to help teach our citizens to better manage at times.
And maybe that's and this is a rhetorical question, but maybe that's an area that we have to do a better job of regulating. I think it's a mystery box of what goes into that credit score and what comes out, and there's the different companies. And somehow there's a deal that everybody has made inside of this area that we don't get the information about what that actually means and how it means that. So even if we wanted to drill down and say unintentional structural racism is happening here, we couldn't, because we don't know how the credit scores are even obtained, and I don't even think there's a government oversight body that's doing a very good job of seeing how that is. And you end up having competing companies for credit scores, and then I don't know. So there's deeper problems that the city, probably fortunately for our workload, can't be regulating and getting our hands in. But I do appreciate you being here and some of those ideas. And we are working on economic development and jobs and education, and we're investing in the home ownership center too. And we have our housing department and our staff, some of who are listening here right now and being part of this. The other thing we might be able to use a partner on is the concern about people getting steered in certain directions, especially realtors maybe. So it's not even just the lenders that are involved in this; it's everybody. So that's an area that I am concerned about. I did want to ask Professor Orfield if he had a theory about why there's the disparity. Is there at some point where a lender will know the race of the person there, and does that make a difference, do you think?
Well, let me just sort of summarize, I think, where the discussion is right now. We have a situation in the Twin Cities where a black family or a Latino family that earns $167,000 a year is less likely to qualify for a home loan than a white family that earns $40,000 a year. Now, we don't know what goes all into that. The question is, but what you're asked to systematically believe is that the credit scores explain that a black or Latino family that earns $167,000 a year is systematically less creditworthy than a white family that earns $40,000. That may be, but there are studies that I cited on page 15 of our original report, the Avery, Canner, and Cook in 2005, the Bosian, Ernst, and Lee, 2006, Bone, Thistle, and Schlottman, 2006, Corcoran, Sweat, and Zorn, 2004, Dietrich, 2005, and Manel, 1996, Pennington, Cross, 2000. These are all studies that took a look and compared the HMDA data that I had to the credit history data that was made available to those scholars, and they didn't find a big difference in the findings. Now, I was looked for a study, an academic study, that compared that credit history and said that it explained it all. I couldn't find one. And I asked Mr. Blackwell if he'd found one, and I don't think he has found one either. I'm not going to put words in his mouth. But I think what you're asked to systematically believe is that a black family that earns $167,000 a year is systematically less creditworthy than a white family that earns 40, and it may be the case. But I, for one, would like to see the evidence that that's the case.
So if it's not the case, what do you think's going on?
Well, this is a hard question. I mean, these are questions that there are lots of studies we cited, both in terms of people that are making deals across the table. Disparities seem to grow. You know, when loans are mechanized, there seem to be less disparities. Banks not being in minority neighborhoods. I think you know, we have a history of litigation on some of these issues in cities like Memphis and Baltimore, with HMDA data that looks very much like this, with significant settlements by banks to civil rights claimants. So I think it's important to get all the data and get all the facts. You know, maybe the credit history scores explain all this, but it's hard. I think that's a big difference, that a black and Latino family that earns $167,000 a year is systematically less creditworthy than a white family that earns 40. It may be the case, but I, for one, if I were in your shoes, would like to see more evidence of that. And also see studies. The studies I cited suggest that the credit scores don't make that difference. These are 7 published studies, peer-reviewed published studies. Maybe there are other studies that go otherwise. I haven't found them.
Well, and I understand that, and don't forget there's also the value of the property, there's the debt-to-income ratio. I mean, there's a few other variables that we heard about today that apparently go into the equation. My last question for you, and I appreciate the tolerance, Mr. Chair, is what's the Fair Housing Center, or what was that?
There was a not-for-profit organization that was a fair housing center that monitored all of these things. I mean, as I said today, I don't think that there's just one thing. It's not. There's lots of kinds of fair housing issues. There's steering, as we talked about, the private market. There's the concentration of subsidized housing in poor neighborhoods. There's exclusionary zoning. There is the way that school districts are drawing their attendance boundaries that are often in the cities and the suburbs that all accelerate these trends. And the Fair Housing Center, there was a Fair Housing Center during the 90s that tried to watch mortgage lending and all these other things. They used to do they used to do testing studies with individuals entering the housing market and rental markets and things like that. But they went out of business in the late 90s.
I think that would be fantastic
Yep.
to have that. It sounds like it could have been useful.
Councilmember Palmisano.
Thank you, Mr. Chair. This is in a similar vein as Councilmember Gordon's comments. Thank you, Mr. Kwani and Mr. Blackwell, for being here, and it's good to hear your assertions about being a community player. I know we've all seen Wells Fargo's charitable efforts. Your community engagement and partnership is unmatched in your industry, and particularly in your efforts in collaboration with our former Housing Policy Director, Tom Streitz. I know you also appreciate that the solutions in this ecosystem of racial disparities that we're dealing with is very complex. So if I could maybe be a little bit more forward than Councilmember Gordon, could banks, meaning Wells Fargo and your own subsidiaries, make a researchable amount of history, background history, credit history, or whatever, cleaned of private personal data, and other factors which you've mentioned, available for study, either by the University of Minnesota or by a third-party institution? Secondly, I'm curious, I mean, I feel that your own lending business could ultimately benefit, as well as these fragile parts of our cities could benefit from that kind of inquiry. You know, you're being the leaders here in this part of your industry, and you clearly care, and that would be kind of innovative and go way beyond what Dodd-Frank can give us today. I also want to know, how will you help us, or how might you help us in new ways, specifically in these parts of our city? I think financial education is one great idea, not just in traditional schools, but in places like Summit Academy in an adult education kind of way might also help. But what can we as a city do to get you to put a bank in some of these neighborhoods?
I'll try both. So in terms of your first suggestion that we make data available for study, as Brad Blackwell indicated, there's a lot of good work going on right now with the Consumer Financial Protection, the CFPB, and the CFPB is going to publish that. They're going to agree on what that data should look like. And at this point, our position is we should be uniform across the industry in releasing that data, and we're hopeful that that's going to come soon. So that's our current position on that. We're happy to have ongoing conversation about that. In terms of what more we can do in terms of banks, like I mentioned in my remarks, we do have the most bank stores in the city of Minneapolis of any bank, and we're proud of our banks in Minneapolis. We have the store managers here from our store on Central Avenue, from our store in Camden, from several of our other stores here in downtown. We are confidentially, I guess it's not confidential anymore if I say it, but we're working with Ryan on the possibility of having a bank in the new building that we're actually a retail location in the bank that we're building, or the building that we're building in downtown East. We think that would be great to have a store there if we can pull that off. And so we are very committed to having stores, and in those stores we do provide a lot of financial education. I think that it's a good suggestion that the store managers and the district managers, myself, that we work together to determine what more we can do to be sure that we're providing education to the citizens of the city of Minneapolis. We like to have opportunities to actually go into the public schools, and we have a hands-on banking program that we leverage to provide that education. We have a center in our Olson Highway store where we provide opportunities for education to adults for financial education. Our store managers and our team members in the stores in Minneapolis are very willing to provide education. So any suggestions that any of the council members have related to how we could do more outreach from a financial education perspective, we would be really interested in having constructive dialogue around that. Thank you for the questions.
Thank you. And is there anything specific that we could do in some of these neighborhoods that would attract, you think, a retail banking place into some of the areas outlined in Dr. Orfield's report?
Well, if you have specific examples of neighborhoods, the number of stores that we have in Minneapolis is, we have quite a few. So if there are specific neighborhoods where you'd like us to consider having a store that we don't have one, we'd be happy to have conversation about that.
Thank you.
Thanks.
Council President Johnson.
Thank you, Mr. Chair. Professor Orfield knows this very well. I feel like I've ridden this roller coaster that we've been on with sort of the subprime mess, the flop, recession, and now the challenge of getting a marketplace back in place that encourages home ownership in the neighborhoods that the professor is talking about. And it really is a huge challenge. Bad actors see opportunities and take advantage of them, and that is what we were seeing. I will never forget sitting in this committee and it was actually when we still had regulatory in the mix, and there had been a property that had been fire damaged on Fremont Avenue North, and our regulatory staff wanted to tear it down because it was really very badly damaged, and so they came in with this report about, we need to tear this property down. And I've lived there so long, I can picture properties in my head. When somebody gives me an address, I can usually figure out what I'm thinking about. And this property at the time had I will never forget this, a $230,000 mortgage from Deutsche Bank on it. And I thought to myself, what is going on that this property on Fremont Avenue North had a $230,000 mortgage from a bank in Germany? This is nuts. And that's when it finally hit me, and I was behind all the really smart people, obviously, that there was something crazy going on with this mortgage market. So I want to say, in my experience, and I, again, represent part of North Minneapolis, I have a branch of Wells Fargo Bank in North Minneapolis, and correct me if I'm wrong, we have two Wells Fargo branches, one on 7th Street and one in Camden. We have a U.S. Bank on Broadway, and we have a Sunrise Bank on Washington Avenue North. That's the extent of the banks that we have. So, across the rest of the city, there's other people that are interested in the marketplace, other bankers. But these are the people that are the hometown folks, and they have stuck with us. When the tornado damaged the Camden branch, it was a mess. There was about $250,000 worth of repairs that needed to be done in that building, and Wells Fargo could easily said, this is just not worth, for the traffic that we get in this particular facility, it's just not worth putting that money in. But they did, and they're a great neighbor. If we ever have a problem, we call them. Been my experience during this whole foreclosure thing too, to be able to, if you do have an issue with the property that's been abandoned and foreclosed, to have somebody to call. Try getting a hold of, I can't even think of some of these people in, Atlanta and banks that are out of state that, who do you contact? There's no contact information. It's ridiculous. So thank goodness we have some people that are interested in our community enough to respond. So I just think, and it was really interesting listening to the multiple factors in making a loan decision. And I never thought about what Councilmember Gordon was saying, and I think that that really is interesting to think about too. You talked about the what was it? The dependability of income. So you get a paycheck every 2 weeks, you're in pretty good shape. They say give you a year of your W-4s or whatever, and you can get it. But there are a lot of people that are self-employed, and that's a real challenge. And I would imagine some of our newer immigrant communities, there's more people that are self-employed, and so that may be one of those factors that is more challenging for some of those folks. So I really think that's a great idea, Councilmember Gordon, and maybe the banking industry can help us think about that. What are the factors beyond credit history and credit history? And I don't think we can ignore credit history. Everybody knows that. You buy a car, anything, people are going to say, do you pay your Macy's bill, your credit card bill? It's part of life. And so, but I do think digging into those other factors, you might actually come up with some thoughts that, could be helpful in making this, or dealing with this problem. The other thing that I think is important, and I would encourage Wells Fargo and U.S. Bank and the responsible lenders that we have in our community to think about, one of the things that's happening right now in these neighborhoods that are challenged, a lot of the people that were foreclosed on, want to be homeowners again. And they have damaged credit. And one of the programs that we've had some experience in having success with is, and I know Urban Homeworks does it, and then also Gimmick, where it's a contract for deed. And it's a responsible contract for deed for people with bruised credit. And they are, their payments are, continue to help pay down the eventual price of the loan. And during that time when they're working on it, they actually have the credit counseling, the financial literacy help that helps them, keep that credit score up and their bills current and that sort of thing. So I'm sure you support, in your efforts, those really great nonprofits that work in our community. So I just, that put a plug in for them because they're doing great work. They're finding homes for people, they're rehabbing homes, and getting them back to those people who, when they had one of these subprime loans, they felt really bad because they were living in a nice neighborhood, and they want to go back there, and that it's a real opportunity. So I hope we can work together and continue to address some of these problems. And Professor Orfield, I want to say I appreciate your work so much because I think you point out things that people don't want to hear a lot of times, but it's reality in our communities that are challenged. And I think we all have to keep thinking about how can we make the difference to change some of those dynamics. And I think there's a lot of ways that we can in working with our partners in providing financial services in our city are one way that we can. Thank you.
Any other questions? So the problem with being the chair is that I tend to let the questions go first, and so everyone's asked the good questions, so I kind of get to ask the not so good questions. But if I may, Mr. Kwame, you had talked about anybody having any suggestions. I really do have a suggestion for a branch store somewhere on West Broadway. We'd love to have one. I know that technically we can count the one on West 7th as kind of a branch in Ward 5, but I mean, that's kind of in the North Loop area, and they're included in Ward 5, but I mean, we'd love one that is much more, let's say, in the heart of North Minneapolis there on West Broadway, and I know a spot for that, but, there are other spots as well, and you can build a brand new spanking building there for all I care. I mean, I'd love to see that. I think, this discussion has talked a little bit about, Professor Orfield talks about, redlining happening in the metro area and in Minneapolis. And, Mr. Blackwell talked about no redlining at all. And, maybe it's somewhere in between, and maybe it's not Wells Fargo, maybe it's some other actors. But, for myself, I think one thing that really would go to that point and that would really help shed some light on that is exactly what Councilmember Palmisano had mentioned earlier, which is, open your books up, let Professor Orfield look at them, and, do whatever you need to protect your clients and protect confidentiality. But, let's just, have a litmus test to see, whether it is happening or not. I think that'd be fair, and that would, help the public. And, as Councilmember Palmisano had mentioned, if Professor Orfield can prove that Wells Fargo isn't doing it, I think it'd just be wonderful. I think your business would just skyrocket. So, I think that'd be a wonderful thing. I guess I just had a simple question with regards to the percentage of, or the mortgages that are held by folks who live in Minneapolis are about 24,000. And I'm wondering, in terms of the percentage of people of color who are the mortgage holders, do you know a number? And if you can get back to me, that'd be wonderful. I'd love that. And Professor Orfield, I do have a couple of questions if you can come up. In your reports, you have two different time periods, and I'm wondering what the significance of each of those time periods are. One is from 2004 to 2006, and one is from 2009 to 2012. And why did you pick those two times?
Well, the first report we did was during the heart of the mortgage crisis to try to understand the racial, map out the racial impacts of the mortgage crisis. And then we wanted to wait until some time had passed and see how lending had changed, and to see whether the mortgage crisis and all of the regulatory actions and litigation and so forth had changed behavior in these cities, and whether these poorer non-white neighborhoods were getting more access to credit or not. So those were the reasons that we did that. Okay, and in your report, you suggested that there were some bad actors, but there was one specific actor that you had said was maybe in my terms, nobody else's term, a good actor, and that was TCF. And what were the reasons why? You suggested. What's your theory on that? Yeah, I don't know. We just looked at the banks, and during that period in the mortgage crisis, TCF stood out as being a little bit more proactive in those neighborhoods. And I don't know the reasons why. I could go back and look at that. I haven't looked at the study for a while, but there were a few. There was some differential behavior. Some banks were doing better than others, and TCF was one of the ones that seemed like it was doing a little better. And not spectacularly, but
okay. My last question is just, we're talking about this. What do you suggest is the role of the city in all of this?
Well, I think it's important to really do due diligence, and I think that the banks raise a good point. The data is incomplete, and as far as I can tell, though, where the data is made more complete, it doesn't change. It looks the same. And if that's the case, then I think that's a problem. So I think, doing due diligence on the data, really looking hard to see whether Black and Latino families that earn $167,000 a year are systematically less creditworthy than white families that earn $40,000. It's hard for me to just accept that as the case. That's a big number. That's a big difference. It could be true, but I think that in the places that I've found, and I can't promise that I've looked at every study. I've tried to search as much as I can. on this. I can't find any that where this makes a huge difference. But I think so doing that due diligence, taking the next step. And I think also the city should think about all of its roles in this, affordable housing policy and the city zoning policy. If the city is placing all of its affordable housing in very poor neighborhoods, that's not helping. If zoning is concentrating low-income people in poor neighborhoods, that's not helping. If the school district is creating boundaries that separate kids on the basis of race, that's not helping. If real estate steering is happening, that's not helping. There's lots of pieces in this that, you know, it's not one entity, but this is a pretty sharp disparity. These disparities are as sharp as I've seen anywhere in the country. And obviously the data is incomplete. We can't say that it's perfect, but we also I haven't seen a study where getting the full complement of data changes this picture. And there's been quite a lot of litigation this year and a number of fairly large settlements based on claims quite like this in different parts of the country. And that tends to point to the fact that there's a problem here that needs to be looked at. We looked at whatever was publicly available. We looked at whatever was available. We tried to find every inch of data that was available to scholars, and we looked at it and tried to look at it diligently and do a literature review. But obviously there's more to lending than just the HMDA data. But it is a pretty good, it has been a fairly good predictor.
Council President Johnson.
Thank you, Mr. Chair. Just a question about when because of Dodd-Frank, when that data will become available. I was worried when I hear Congress is going to make rules, because that kind of can take a really long time these days.
Yeah, Madam President, the Congress has already passed the bill, which is the good news. They've turned over the regulatory responsibility to the CFPB. They're in the process of developing those guidelines. I'm not sure when the deadline is, but I do believe we're expecting something within the next year or two that will then determine that more of this information will be reported.
Available. Okay. Thank you.
Oh, Councilmember Reich.
Thank you, Mr. Chair. Just sort of a clarification. I know there's a lot of issues have been raised, and it's been hinted at several times. I think the term ecosystem of problems that we're trying to address here, and we of course have the focal point of the topic today. But just in terms of this committee's workload, I just want to get clarification as a newer member of this committee. You know, is this a civil rights thing? I mean, what piece of it is this committee taking on, knowing that there's many pieces that go well beyond the scope of this jurisdiction, let alone any department? Just so I can get clarification on this, is given the public safety, civil rights, and emergency management focus of this committee.
It'd be the civil rights piece.
Thank you. Oh, and I suppose as a follow-up, what's our jurisdictional impetus on this topic in that wheelhouse, if you will?
Well, it seemed germane simply because the report seemed to reveal some potentially discriminatory practices based on race. So it's not coming forward with a set of recommendations for us to follow up with at this point necessarily. And actually, I know there are discussions going on in other committees and with others about housing and practices and lending practices and foreclosure. And I think there was even a Mr. Orfield's predecessor visited us, John Powell, and gave a presentation to some of council members. I'm not sure if you were there, but Councilmember Glidden's office put that together. So, and that's also why we have housing staff from CPED here to listen to this and help us figure out what should we be doing, who should be doing it, and how can we do it. I don't think that we really have the capacity in the Civil Rights Department right now to go out and do sting operations or test this or that, but everybody should be aware that if they feel they have been discriminated against in buying a home or getting a loan, they can file a complaint with the Civil Rights Department, and we will investigate that.
Okay, I think we're all done with that. You know, clerk, should we receive and file this, or are we just okay? I'm gonna move that we receive and file this presentation. Any discussion? Okay, all those in favor, please say aye. Aye. Opposed? The motion carries. Thank you so much to Professor Orfield. Thank you to Mr. Kwame, Mr. Blackwell, Wells Fargo in general. We typically don't have this sort of crowd, and so you guys brought the crowd, and really thankful for that. Thank you for the information from both parties. This has been very helpful, and so really appreciate you all coming here and sharing the information and, giving us the information. Our last item is an item that's going to take about 5 minutes, and that is from the mayor's office. Diane Halsey is going to be here to present on the Racial Equity Toolkit, Racial Equity Framework, Equitable Solutions for One Minneapolis.
Thank you. Good afternoon, President Yang, Vice President Gordon. I have been asked by the chair to give a very brief update on the racial equity framework and equitable solutions work. Just to reiterate that this work has been kind of reframed, reorganized under the Racial Equity Policy Work Group that is led by the mayor and several council members. Some of you are part of that work group. And we are categorizing the work into 3 areas: the internal work of the internal enterprise of the city, the work that we do internally; external work that we do, any kind of work that impacts residents and businesses of the community; and then partnerships, and that's work that we do in partnerships with others, governments, foundations, nonprofit, and private sector. The policy work group is also working to build off of the work that the city coordinator's office has done to prepare a racial equity action plan, and you probably will be hearing more about that later. Regarding the equitable solutions work, there are items that are going to be coming before the Committee of the Whole, I believe next week, out of that equitable solutions work. One of them is the racial equity assessment, and the others are 2 guides: the recruitment and hiring guide and the boards and commissions guide for staff. There's also been work done on the procurement guide, and these are each items that are being kind of led by different departments. The recruitment and hiring guide, of course, is being led by human resources. Boards and commission is being led by neighborhood community relations, and both the assessment and the procurement guide at this time are being led by staff from Civil Rights Department. So that's my update.
Councilmember Gordon.
Thank you, and I appreciate the update. I've been participating in some of the work groups.
Yep.
And I really appreciate how I think the toolkit is shaping up, that it's getting to be really clear that there's 4 tools that are going to be in our toolkit. They are the guide having to do with human resources issues, the guide that has to do with purchasing, procurement, contracting, and another helpful guide that will have to do with engagement, especially your boards and advisory commissions and that. And then the last thing is the assessment itself. Yep. And I appreciate that it's been whittled down now, I think, through a lot of work in the coordinator's office and then some field testing that's gone on. There's basically 3 questions that people have been asking themselves, and then if they get to the end of the 3 and realize there's impact, there's about 4 more. So just wanted my colleagues to, if they're remembering that lengthy 28 question item.
Changed a lot.
It's changed a lot, and also now the recommendation is this be a tool that would be available for department heads to use when they thought it would be useful. And that's something we'll monitor. So it's not the idea that we're going to say every city decision that's ever made by anybody needs to ask all these questions. I actually think we're seeing a lot of people think about racial equity more just because we've had the discussion, and then if they are thinking about it, there'll at least be a little bit of an assessment that they can use. So I appreciate the work that's gone into it so far, and I think it will be helpful when we have a new city coordinator appointed too, where we can kind of get that work coordinated again maybe and take it a little bit out of the hands of the mayor's very competent and hardworking staff.
Yeah, that's true. That's a good point to make, that the plan is, and has been all along, that the city coordinator, once hired and is on board, will be taking over the overarching work of the racial equity work.
Thank you, Ms. Halsey. And I will move for approval of receiving and filing this report. Any discussion? All right, all those in favor, please say aye. Aye. Oppose? Motion carries. Thank you. And with that, we have no further business before this committee, so we are adjourned. Thank you.